Welcome to my new series of stock market investing tips. I'm Balance Sheets Matter, and I'm going to share my top stock market tips that I've learned over the years that have helped me make millions of dollars in the stock market. So smash that like button and subscribe to my channel for more great stock market tips on investing in the future. Okay, so now in today's video, I'm going to go over why high PE stocks can be some of the best stocks to invest in, and how we can actually use the P ratios of the stocks to figure out how to buy the bottoms and sell the tops. The PE ratio, known as the price to earning ratio, is one of the most common metrics investors look at when investing in a stock. If you look historically, the average PE of the S&P 500 has been about 16. So most investors mistakenly attribute this as a fair value for any stock out there. And anything that's over a 16, a 20, a 30, they will consider overvalued, and anything under, they'll consider it undervalued. Well, I'm going to show you why this is completely wrong. And if you ignore high PE stocks, you can be missing out on some of the best gains in the market. And I'm going to go over not any hype stocks. I'm going to go over in this video CocaCola, Fastenal, and Copart, and show how these great companies have virtually always traded at a high PE ratio. Now let's look at Coca-Cola. Here I have Coca-Cola's 30-year chart, and you can see over the long run there's been decent returns, but there's definitely been good times to buy the stock and bad times to buy the stock. The good times we can consider in 1994, the mid-2000s, such as 2004 to 2006, even 2009, 2010, 2011, even getting into 2012 and 2020, and a lot of these other times, such as in the 2014, 2016, 2018, have been okay, not great. And what's been really bad is if you bought it in the late 90s going into 1998, 1999, where if you bought it up here, you could have had dead money sitting for over a decade. So now let's pop up the PE ratio over it. So here on the very far right, we have on the y-axis, we have the PE ratio, 10, 20, 30, 40, 50. And the first thing you'll notice is that Coca-Cola's PE ratio rarely goes under 20. And the times when it did very poorly, the P ratio was a lot higher, and the times it did very well, the P ratio was a lot lower. So this is the concept I'm talking about of how we can use the P ratio to buy stocks when they're cheap and sell them when they're expensive. So I like to visualize this with some little bands. So I kind of put the green line here, which when we're approaching around this, it could be considered a good value. If it goes under it, even a better value, and we get closer to the red, it's a bad value. But we also have to ignore these anomalies, because these anomalies are sometimes from one-time expenses or one-time incomes that basically make our PE look a little bit off. And you can see if we had bought Coca-Cola anytime in the late 1990s into 2000, where it had massive underperformance, the P ratio was very high and we did very bad. If we bought it in this 2014, 2016, 2017 period, where we're kind of the middle of the bands, well, we didn't get great returns. We didn't lose money, but we probably underperformed the market during this time. And if we bought it when it was at the green band or under it, we did very well buying Coca-Cola. So next, let's jump into Fastenal. Fastenal is a stock I love. I used to own it, but I did sell it using this method, and it's provided over the last 30 years over a 15% compound annual growth rate, meaning that Fastenal has completely just crushed the market. But most investors would never actually invest or get involved in Fastenal because it's virtually always had a high PE ratio. So if you look at the far axis here on the right, we see the PE ratios, and it's virtually always been at a high PE ratio in the mid-20s to the mid-30s, even sometimes going 40. In fact, only one time it went under a 20 PE ratio in 2009. So if you're someone who says, oh, I need a P ratio under 16, you would have never owned Fastenal, and you would have never bought this great stock that's outperformed the market. And we can see the exact same thing in Coca-Cola, but even better, that when the P ratios are high, we typically had lesser gains going forward, and when the P ratio was low, it was the time to buy, and we had better performance going forward. And I had previously bought Fastenal at about $30, just a little bit over during the COVID crash, and then I actually sold it at $60 when the P ratio seemed to be getting a little high, providing myself about 100% gain over just over a year. So the final stock I'm going to go over is Copart. Copart's a stock I recently bought several months ago. I got it about back here at about a $60 cost average, and it's doing quite well right now, pushing about $80. Well, I don't think during the time the market's had any gains. It might even be potentially down from when I originally bought Copart. But as you can see, the PE when I bought it was a little bit relatively lower. It is getting a little bit higher, but with its expected forward earnings, that PE ratio may come down a bit. And as we can see, again, with as similar as Coca-Cola and Fast now, Copart has always had a relatively high P ratio. There's been a lot of times where it did hang around about at this 20 P ratio, but really the only lowest they got was in the high teens. And every time buying it at these levels was a great long-term opportunity to buy the stock. And when it did get to the higher ranges, which is not being actually too frequent, this was a time when maybe we would consider wanting to sell or at least not buy the stock. So I hope you enjoyed the video and found it valuable. This is just one little aspect that I look at when investing in stocks. And I hope looking at this aspect will at least open your mind out there to see that not every stock, every value stock out there is going to be at a low PE. And some of the best stocks to buy out there will be at what are considered higher PEs, potentially in the mid-20s, even high 20 P ratios. So remember to like, share, and subscribe. Stay tuned for the next video. And if you want to leave a comment below of what you'd like to see in the future, or if you have any questions or comments.